Let's talk now with Don in California. Don, you're with Allworth Money Matters.
Hi, guys.
Hi, Don.
So, got a question. We've got a new federal administration. How do I plan for investing when I live here in California and the news is somewhat tilted for California-centric news? How do I make a good decision? Because the stock market and other investments, really you should be looking nationally or even globally to make your decisions.
So, I'm not. Well, we are residents of the state of California,
Right.
So you're worried.
I'm not sure the question because I personally don't watch local news. I look at a couple websites to see what's going on in California. But
so what is your concern? Tell me what your concern is.
Well, I don't watch the news that often. I'm getting ready to roll over into retirement and have to readjust a lot of my investments. Like you, I live here in the Sacramento area, and I know from what little national news I watch and the industry I follow, I know that the local news is tilted.
Okay.
With California. Let me ask this: what news sources do you use to make your decision?
So it's noise. A lot of it is just noise, right? So you got to remember, the job of a news site is to deliver an audience.
And same thing with social media sites.
It's to deliver an audience. That is their objective.
So they can sell advertising.
Yes, that is their objective.
And if they have no eyeballs, then there's no advertising.
And so
revenue.
how do you actually deliver an audience to an advertiser? Well, you sensationalize. You hype things up. You make the world either look so bright and cheery that people are attracted to it, or you look like it's doom and gloom so that eyes are attracted to it. Right?
Usually the doom and gloom.
Yeah,
people want to watch the car crash, right? I mean, it's a...
Yes. I mean, there is, look, you see it every day, right? Gene Hackman dies a couple of weeks ago, and now it's, like, look, there was whatever happened in that house happened in that house. But it doesn't mean... It
is a little interesting.
It is interesting, but it's not going to affect any of us, right? But they're delivering an audience, and they're tracking it too, by the way. So if someone clicks on Gene Hackman, then they know, look, we should run more stories on Gene Hackman. If someone clicks on, hey, look, your IRA and 401k is coming to an end because of this new administration, and you click on it.
So my son's a commercial pilot, and there's in the news, there's been all these near misses, right?
Yeah.
And I asked him, I said, like, is this anything? He says, it's not really any different than normal. It's just everything's being reported. It reminded me when I was in high school, I was living in the Los Angeles area. And if you remember the drive-by shootings, every day in Los Angeles, there was a news story of another drive-by shooting. It was this epidemic of drive-by shootings. And after a while, the news cycle kind of died down. And you look at it statistically, there was nothing had changed. There was no increase in drive-by shootings, right? So some of the news cycle is a bit of that right now.
Right.
Like it's all the sensational. Let's put a flashlight on all this and spotlight on this, and let's drive people to our sites and our TV shows.
And I mean, it's such a divided, right and left in the country right now. So they say, but it was a pretty close election.
That's right. I know. Yeah. I don't know about a landslide. Yeah.
Right.
70% might be a landslide.
So the thing that harms your portfolio the most is
your reaction.
How you react to it. So if you talk to an institutional...
The hardest thing about being an investor.
If you talk to an institutional pension fund manager.
Okay.
Right? If we went and interviewed an institutional pension fund manager and you asked them how they're reacting to
preferably
the news.
An apolitical one. Because they start making weird investment decisions based upon...
Well, ones that are normally governed by boards of state and local have a tendency to actually sway.
Yeah.
But if you went and talked to, someone who's managing the United Auto Workers pension or the whatever pension it is, institutional pension, and you ask them, what are you doing to your portfolio in light of the current political and economic environment? Scott, what would their answer be?
Well, they might be looking for some opportunities to. They move things around the edges. So they might, for example, they might have had 28% in publicly traded securities and 12% in privately held security, private equity, and a small portion in venture stuff. And they might tweak those percentages a couple points here or there, but by and large, they're not having wholesale changes.
They're sticking to the portfolios that are typically 65. Look, I'll tell a story. I was on an investment committee for a foundation, and before I joined, those are
really difficult.
I joined in 2010. Before I joined, 2011. Before I joined, in the height of the crisis, the Great Recession, they lowered their equity portfolio in the middle of the downturn. And
you were on the board?
I was not on the board.
Oh.
I joined soon after. But then I got back on the board and I said, well, this makes no sense. We shouldn't be reacting to that. So we got them back to 65%. And then the big question was, should it be 63% equities or 66% equities? And you're laughing. Why are you laughing?
It's not going to make any difference long term.
That's what I said.
Come on.
I said, so we've spent 2 hours talking about.
Well, those boards, those small foundations.
Because everyone wants to show that they're the smartest guy in the room.
They all want to add some value, but they don't really know what they're talking about.
These were filled with investment professionals, but everyone wanted to show how smart they were. And I said, look, over the next 5-10 years, whether we make it 66% stock or 64% stock, the most important thing is that we're in the range of the stock that we should be.
Yeah, so you're marching towards retirement. When do you retire, Don?
This summer.
Okay, you're retiring this summer.
How old are you?
65.
So are you married?
Yes.
Okay, so one of you is going to live statistically to be 95 years of age.
It'll be her.
Okay. So
is she going to kill you?
So
being home too much?
Your investment timeline
is long.
Is 30 plus years. And we see this often where people actually go into retirement and all of a sudden feel that they need to make major changes in their investment portfolios in order normally to be too conservative. And doing that creates all kinds of problems. What you should have been doing is titrating your risk down closer to retirement. So if you were in your 30s and 40s and even early 50s, you might have 100% equities the whole time. And as you get closer to retirement, maybe it goes 90%, 80%, 70%. And then it depends on your net worth. So if your net worth's really high, right? Let's say you're worth $10 million and you're taking income of, a couple $100,000 a year, then you can do whatever you want.
And I think it's one of the things that's really hard as we approach retirement, and particularly once we go into retirement, your whole career, you've been used to having some money set aside for the future, right? So you're putting money, presumably into your 401k and other savings. You've been saving. So even though things have fluctuated, you're still adding to that every day. You're putting logs on the wood pile, so to speak. Now you go into retirement. Now you're not saving anymore. Now you're starting to take wood off that wood pile. So you don't have the money going in, which is putting a different kind of pressure on the portfolio. And then secondly, now you've got time to sit and monitor all this stuff. And maybe you feel like you've got a fiduciary responsibility. This wasn't the wise thing to do, is to spend a lot of time on it. And you could drive yourself nuts.
So let's talk about your own financial situation. Do you have a pension coming in?
I will, yes.
How big is your pension?
Roughly 65% of my income.
Okay.
And do you have money saved in a 401k, IRAs, that sort of thing?
Yeah.
And how much is there?
About $250,000.
$250,000.
And are you going to receive Social Security as well?
Not if I go in to do some consulting, because I don't want to lose. Don't want to have to pay them.
And what's your 250,000? How's it allocated today?
Mostly in large and mid cap stocks.
Is it all equities?
Pretty much.
All stock.
Oh,
Yeah.
that served you very well.
Yes. You should probably lower that, right? To probably.
And do you have money in savings, CDs, money market, that sort of thing to speak of?
Just about a month's worth of salary.
Okay.
And so your plan is to do some consulting. At some point in time, you're going to take Social Security, which is you're essentially going to have 100% of your income made up between your pension and Social Security, right?
Pretty much.
And so the 401k is probably going to be for different things. Need a new car, want to take a trip.
Yes.
Right.
So one way to look at this is say, of this 401k, what do we plan on spending out of this in the next 5 years? Or what do we want to budget for expenditures for the next 5 years? Have those dollars be in conservative investments, and anything 5+ years, continue having equities.
Okay.
And here's one of the benefits of time, getting older, is we've lived through all these different times, right? So if we think back to the .com bust, and we all remember that, pets.com, everything was going crazy, and then they went big. So the Dow Jones Industrial Average in the year 2000 hit 10,000. This was at the height of Greenspan talked about irrational exuberance, right? And it was a couple years after that. We hit 10,000. We went through the .com bust. Stock market declined 45%. We had 9/11 in the middle of that, all that. We had some recovery. Then we went through the financial recession, the Great Recession. Stock market was down about 50%. And today the Dow's over 40,000.
And we went through all that.
4x over 25 years. To Pat's point, odds are one of you are going to still be alive in 45 years. So if you can pull
30
back,
years, 30 years.
If you can pull back and say, of these dollars, these are long-term dollars. I'm not going to focus on the value of these on a daily basis because I'm more concerned about what these are going to be worth 10, 15, 20 years from now. Then you could say rationally, markets are going to go through their cycles. They're going to recover. Things are going to go up. And then have those dollars that you're going to need that you want to rely upon in the next 5 years or so in something very conservative. And if you can get your mindset in the right way, then you're not going to worry about it when the market goes through a 20% correction, which it will.
Yes, it will absolutely happen. And remember,
we don't know when.
Media, it's not your friend. You are being sold, right?
Right.
That's what happens. And so they want to engage you as much as possible. So don't pay too much attention to the price.
Yeah. I appreciate the call, Don, and hope you have a fantastic retirement.